Everything you know about investing is wrong. The reason why over 90% of people fail at beating the market is because it's far more counterintuitive than it looks, and requires mastering your own psychology. While there are no guarantees when it comes to investing, following these 21 principles will significantly increase your odds of long-term success as an investor. Principle 1: Stock prices follow revenue and earnings growth over the long run. Only invest long-term. There are so many variables that go into a stock price in the short term. This makes the short term very unpredictable. The long term is far more predictable. This is because stock prices follow revenue and earnings growth over the long term. Businesses can become very complex as they grow, but at their core, their success is determined by their ability to grow revenue and profits. Pro tip: many investors get enticed by cool new technologies, but it's not guaranteed that something can be successfully productized out of them and generate actual sales. Always look for how the things a company is working on can translate into actual sales of a product or service. When it comes to revenue and profit growth, pay attention to the company's compounding annual growth rate, CAGR. Compounding causes exponential growth. And the best opportunities can be found by investors who identify exponential growth early. This is because it starts slow. Then it accelerates. The numbers increase slowly until they start to get big fast. People think about growth linearly, so they don't see it coming when it's exponential. It creeps up on the world unexpectedly. Principle 2: Time in the market is more important than timing the market. In the short run, the stock market is a voting machine. In the long run, it's a weighing machine. Warren Buffett. Most people would perform much better in the market if they couldn't sell a stock for 10 years after they bought it. I spent years failing as a day trader when I first started playing around in the market over 15 years ago. Even Warren Buffett admittedly spent the first 8 years of his investment career trying to time the market. We both had to get these data points for ourselves to learn what doesn't work sustainably over the long run in order to know what to avoid. Like most newcomers, I was enticed by the promise of fast, easy money, only to realize later on that most people spend their lives failing to reach success because they allow themselves to be distracted by the chase of fast money, instead of learning the power of compound growth paired with patience. Here's why compounding and time are such a powerful combination. Let's say you start with $60,000. If you make a 10% return in your first year, you'd have $66,000 at the end of the year, because 10% of $60,000 is $6,000, so you add your $6,000 gains onto the original $60,000 to get $66,000. If you make a 10% return the next year, you'd end your second year with $72,600, because 10% of $66,000 is $6,600, so you add $6,600 onto the $66,000 to get $72,600. Let's say you continued earning that 10% annual return for 10 years. You'd have $155,624. After 20 years, you'd have $403,650. After 30 years, you'd have over $1 million. All from that original $60,000. Your brain defaults to thinking about 10% in terms of 10% of the original investment amount. But each year you earn 10%, it's 10% of a bigger number, then 10% of an even bigger number. And so on. That's why Einstein called compound interest man's greatest invention. Principle 3: Use bottom-up analysis in addition to top-down analysis. Most people use top-down thinking when trying to evaluate an investment. But you should also pair that with at least some basic back-of-the-napkin math bottom-up analysis. I.e., company X sells X number of widgets for X dollars each and it costs them X dollars to make each unit, usually using average selling cost. Plug in numbers, ranging from conservative to ambitious, to model out their potential projected revenue, margin and earnings probabilistically. This is how real projection modeling is done versus saying, X market is X dollars in total market size, so if company X has X% market share they should be worth X dollars. A company's value, market cap, is determined by whatever multiple the market gives it on its earnings, or revenue if not yet profitable. Once you've modeled out future potential earnings, you can determine a spectrum of potential future valuations for the company, depending on how generous a multiple the market would give those earnings. The market gives more generous multiples when a company is growing fast and or expected to grow fast, as well as during times when the macroeconomy is booming and has a healthy outlook. Multiples get compressed in recessionary environments and when the Federal Reserve raises interest rates to combat inflation, like we've currently experienced in the 2022 to 2023 market. This is why stock prices can tank even while a company is growing. It's common for the market to temporarily overcorrect to both the downside and the upside. Okay. While I have just stressed about the importance of bottom-up analysis, it's always also important to know the total addressable market, TAM, for the products/services a company offers, to help determine how much growth is ultimately possible. A business can dominate its industry, but if we're talking about a tiny niche industry, the investment potential is severely limited, unless they expand their business horizontally into larger TAMs. Don't immediately write off a company dominating a small niche though, since it's often the best strategy for a new company to monopolize a niche before leveraging that success and brand recognition to expand outward. Example, Amazon expanding from originally selling books to selling everything. Markets that are massive today started as what may have seemed like small niches until those niches became the new standard. That's how disruption plays out, just as we are in the early stages of witnessing with battery electric vehicles, BEVs, replacing internal combustion engine, ICE, vehicles. Today, only about 11% of new car sales globally are battery electric vehicles and only about 2% of the global fleet of vehicles on the road are electric. So it may seem like the TAM for battery electric vehicles is heavily limited. However, the small battery electric vehicle market is growing at a compounding rate of 50% or more a year, while the internal combustion engine vehicle market is shrinking. Extrapolate this out over the next few decades and we're in a world where the battery electric vehicle market is the auto market and internal combustion engine vehicles are as rare as horses. By the way, major governments around the world already have mandates and plans to ban sales of new internal combustion engine vehicles by 2030 to 2040, with some even sooner. So it's something you can have high conviction about in terms of predicting how it plays out over the long term. This is why it's not wise to ignore players dominating what seems like a small niche today. There's major opportunity finding big players in those small, but fast-growing niches that eventually become the new standard. Principle 4: Seek truth always, no matter how harsh it can be. An investor's primary job is to be a BS detective in a world that's flooded with BS. In business and investing, your success is determined by your ability to seek truth. That's why the best businesses are truly customer-centric. At the end of the day, your customers are your source of truth. They will show you how much they love what you're selling with their dollars and actions, for example telling all their friends about it. Oftentimes, the truth can be staring you in the face, but it's far from obvious. Dive deep into what may seem like trivial nuance and let the market tell you what's trivial to them or not. The difference between bankruptcy versus billions in profit for a business is often determined by something that seems so nuanced on the surface. For example, Instagram was just seen as playful photo filters, but became one of the largest social networks in history, despite there being so many competing startups working on photo apps at the time. Tesla is another good example. Today, many still just see it as a car company. But they have one of the world's most skilled AI teams working on solving real-world computer vision. This technology is not only the brain behind the full self-driving capability in their cars, but it's already being used, additionally, as the brain of their humanoid robot prototype. It's a Trojan horse that few see coming because they're just a car company to most people you know. As an investor, it's your job to go full detective to determine the nuggets of insight that almost feel like secrets, since few people recognize them, but they can often become the core of your investment thesis. Question everything and everyone, especially yourself. After 15+ years investing and following businesses/business leaders, I've learned one thing. No one knows anything for sure. Don't let traditional societal marks of credibility prevent you from questioning so-called experts. Experts are wrong all the time. Always being skeptical means listening to a variety of data points that both align and misalign with your thesis. Know the context behind the source that is providing you information. Mainstream media is often biased because they can't piss off their advertisers. You don't want to bite the hand that feeds you. Analysts typically have a bullish or bearish stance on a company, and will often suppress the information that challenges their viewpoint. An effective way to avoid groupthink and confirmation bias is to change your perspective from "how can I prove my thesis right?" to "how can I prove my thesis wrong?" You'll start to seek out the harsh truths that expose the risks to your investment. This is easier said than done, and it takes time to retrain your mind to work this way. It's human nature to be tribal, so you're fighting against your own natural tendencies. But at the end of the day, investing is a game of risk management. And you can't manage risks if you're not even letting yourself be exposed to them. The best investors can talk openly about all risks they've identified. But also don't let short-term noise make them lose sight of the bigger picture. Use Twitter, YouTube, Google, Facebook groups, etc. versus solely mainstream media to get a range of sources.